Silver prices have dropped about 25% after a strong run-up. That kind of move is catching a lot of people off guard. Normally, people expect silver to rise during uncertain times. But this drop shows that markets don't always behave the way we think they will. This decline is not random. It is the result of a fast price increase, changing behavior from buyers, and pressure from other parts of the financial system. To understand what's going on, you have to look at what happened before the drop. Silver had already climbed quickly, moving from around $60 to $80, which is a gain of over 33%. I need to pause briefly. My analytics show me that most of you watching this video have not yet subscribed to this channel. Please hit that subscribe button so we can get this information to you the moment it drops. When prices rise that fast, it attracts more buyers, including people who are trying to take advantage of the upward move. But when uncertainty increases, those same people often decide to sell and lock in their gains. If silver then falls from $80 to $65, that's about a 19% decline. And for someone holding 1,000 ounces, that's a change of roughly $15,000. Another key point is how silver is performing compared to other markets. While silver has dropped about 25%, the broader stock market has only fallen around 5%. That tells you silver is not acting like a safe place to store money right now. Instead, it's reacting more like a regular asset that goes up and down based on buying and selling pressure. Interest rates are also playing a role. When safer investments are offering returns of around 4%, some investors choose those options instead of holding silver, which does not pay income. This reduces demand in the short term. At the same time, silver has struggled to stay above key levels like $70, and when it falls below that level to around $66, it signals that buyers are not stepping in strongly enough. In the end, this drop does not mean silver has lost its long-term value. Instead, it shows how markets adjust after moving too far too fast. Prices go up, then they pull back, and during that process, behavior changes. Understanding these patterns can help you stay focused and avoid reacting emotionally to short-term moves. What you're about to see is a dealer admitting that he should have sold earlier, and that statement is backed by the numbers. When silver moves from $89 down to $70, that's a drop of roughly 21%, and if it continues down towards $65, that becomes closer to a 27% decline. For someone holding 500 ounces, that difference represents a change of over $12,000 in value. These are not small swings. They directly impact decisions. The key detail is how price behaved during the decline. Instead of falling and then bouncing strongly, silver dropped in stages. For example, a move from $80 to $75 might look manageable, but when it continues from $75 to $70 and then struggles to hold that level, it shows that buyers are not stepping in with strength. Each step lower builds pressure, and each failed bounce makes it harder for price to recover. Another important factor is how quickly those changes can happen. A move of $3 in a single day across a 500-ounce position equals $1,500, and when that happens repeatedly over several days, it adds up fast. Dealers watch this closely because they operate on tight margins. If they miss the moment when price is still strong, they can see profits shrink quickly as the market moves against them. What this dealer is saying is not just regret, it is a reflection of how quickly the market can shift. A move of over $20 from peak to current levels shows how fast conditions can change. And when you combine large drops, weak bounces, and failed support levels, it becomes clear why timing matters. Because once the window to sell at higher prices closes, the numbers change.